Ever pay a card bill and think, where did my paycheck go? You're not alone. Today, we'll cut through the noise. Cash stuffing versus rewards, psychology versus math.
And show exactly how to avoid the APR invisible tax, build credit safely,
And stop impulse spending. Practical tips, clear next steps, and a 60-second checklist at the end.
Okay, let's unpack this. Did you know, and get this, total U.S. household debt recently smashed through like $18.39 trillion.
Trillion is a number that's almost meaningless. It's so big.
Exactly. It's hard to even picture. And yeah, mortgages are the big chunk, but that nagging credit card debt, the high interest kind, that's a massive weight on millions.
It really is.
So this deep dive, it's not really about just saying avoid debt. It's more about asking, how can you make debt work for you? Turn it from a trap into maybe leverage.
Right. And what's fascinating here, I think, is that it's not just one battle, is it? It's like psychology versus pure math.
Yeah.
And figuring out where you land on that spectrum is so critical.
Yeah.
We got to look past the viral trends, whether it's cash is king or credit gives you power, and really analyze which tool, cash or credit, actually helps build wealth for different people, especially right now.
Because figuring out how to handle that conflict, the convenience and like optimization power of credit versus the discipline, the safety of cash, that's huge for your bottom line long term.
Absolutely crucial.
So let's start with what does the landscape look like today? How are people actually paying for stuff?
Well, despite all the talk about going cashless, credit is still king, really.
You see it everywhere.
The average American holding 4 credit cards. And digital payments, whether that's credit or debit, they just dominate everyday buying. We're definitely a nation hooked on plastic.
But it's getting more complicated, isn't it?
Oh, totally. Because then you have this massive rise.
Smash that subscribe, ring the bell, and stick around. Check out Jay's. More's coming.
Especially over the last few years of buy now, pay later, BNPL.
Yeah.
Affirm, Klarna.
Everywhere online.
Yeah. And younger generations particularly seem to love it. It kind of offers that function of credit splitting a big payment into smaller chunks, but often with like a flashy 0% interest rate advertised.
Which sounds amazing on the surface, right? Defer the payment, skip the nasty 21% APR you see on cards. What's the catch?
Exactly. It sounds perfect. But that convenience, it definitely has hidden teeth. That 0% is tempting, but if you miss just one payment on those BNPL plans, the risk shoots up. Huge late fees, penalties. And critically, while it might not hit your credit report right away, if you fail to pay and it gets sold to collections, it absolutely can damage your credit score down the line.
So it shows people want the flexibility, maybe, but not the full commitment or the potential pain of a traditional credit card.
That seems to be the psychology, yeah. They want to function without the perceived danger.
But then, at the exact same time, you see this completely opposite thing blowing up, visually anyway, like on TikTok.
Oh, hashtag cash stuffing.
Billions of views. Gen Z seems really into it. Yeah. Taking physical cash, putting it in envelopes labeled groceries, rent, fun money, whatever.
Subscribe now, tap the bell, and drop your thoughts in the comments.
Tracking it by hand.
And that reflects this really deep desire for immediate control, right? Physical accountability. It's a gut reaction against how abstract digital money feels.
Where it's just a tap or a click. Painless.
Exactly. Painless until the bill comes. So this cash stuffing thing, it raises a really important question. Overall cash use is down maybe like 14% of transactions now.
Still seems surprisingly high to me, actually.
Well, yeah, but think about why it's still essential for survival, for, say, low-income folks or the unbanked. For them, cash is immediate. It's easier to budget, control, and honestly, there's often a deep distrust of banks.
So cash offers control and bypasses that whole system.
Precisely. It's about survival and direct management for some groups.
So it's like we have these two competing ideas of what smart finance even means. One is all about optimizing leverage rewards.
Right, gaming the system, essentially.
And the other is purely about control. Preventing disaster, stop the bleeding.
Yeah, fundamentally different philosophies based on circumstance and maybe even personality.
Okay, let's dig into credit then. What are the actual upsides? The superpowers, as you called them.
All right, superpower number 1, no question. The credit score. That 3-digit number. It's not just a score, it's pure financial leverage in the U.S.
It unlocks things.
Totally. It's absolutely crucial for getting the best rates on the big stuff. We're talking saving tens, even hundreds of thousands on a mortgage over 30 years, getting a decent car loan rate, sometimes even renting an apartment or getting a professional license depends on it.
Right. If you don't have a good score, you end up paying more for, well, everything. It's like a tax on being poor or having bad credit.
That's exactly what it is.
Yeah.
The poor tax. And the other big perk you hear about constantly, rewards.
Ah, yes. The points, the miles, the cashback, the fun stuff.
The fun stuff, if you play it right. People who are disciplined, they turn this into a serious strategy. We saw one example. Someone shared they and their spouse net about $2,000 a year just by putting everything on rewards cards.
Everything, like bills, groceries.
Everything they possibly could. But, and this is the crucial part, paying the balance off in full every single month. Plus, you get that fraud protection right. Your liability is usually capped at $50 if your card gets stolen or hacked. That's real peace of mind,
Okay.
but with great power.
Comes great risk.
Exactly. Brings us to the invisible tax that just crushes millions. The monster under the bed is the average percentage rate, the APR. Mid-2024, the average was what, like 21.76%.
Wow. Yeah, that's staggering. Can you break that down? What does 21.76% actually cost someone? Make it real.
Okay, let's do a quick scenario. Imagine you rack up a $5,000 balance. Maybe a medical emergency, maybe you went overboard on holidays, whatever.
Happens easily.
Right. If you carry that $5,000 at 21.76% APR, and you only pay the minimum, which is usually tiny, like 1.3% of the balance plus the interest,
Yeah.
you'll pay almost $1,100 in interest alone in the first year. Just interest.
That's $1,000 for nothing.
For nothing. And if you only ever pay the minimum, that $5,000 could take you like well over a decade to pay off and cost you thousands and thousands more in interest along the way. That invisible tax, it just eats any 2% cash back you thought you were earning. Gone.
Yeah.
Instantly.
And that's just the math part. Then there's the psychology, right? The way it makes you spend.
Oh, absolutely. Study after study shows this. People spend significantly more, sometimes up to 100% more, when they use plastic, versus handing over actual physical cash.
Because it doesn't feel real. There's no pain of paying.
Exactly. That physical sensation of handing over bills, seeing your wallet get thinner, it's a natural brake on spending. Plastic removes that brake. So you make impulse purchases. You might feel good earning $100 in cash back.
Right. Yeah, it feels like a win.
But if using the card tricked your brain into spending an extra $300 on stuff you didn't really need, you're not winning. You're down $200.
Deeply negative.
Which is why some critics call rewards programs regressive. Because think about it. The rewards flowing to the disciplined folks who pay their balances. That money has to come from somewhere.
It's funded by.
It's largely funded by the massive interest payments from people who can't pay their balance in full. Often the people who can least afford it. It's kind of a closed loop, financed by debt.
Okay, so if someone is stuck in that cycle, drowning in that high interest debt, the advice is often to switch to cash or debit, right? Cut up the cards.
For someone really struggling, yes, it's the fastest way to stop the bleeding. The discipline is built in. You literally cannot spend money you don't physically have in your account or your hand.
Instant control. Stops the interest clock.
Exactly. And the anecdotal evidence backs it up. We saw one user reported cutting their discretionary spending by 7% in just 3 months after going cold turkey with a cash envelope system.
Just 7%. Doesn't sound huge, but
But think about it. That's 7% less going out the door, month after month. That physical barrier, having to go to the ATM, count out the bills, physically hand them over, it just makes you more mindful. It forces you to feel the scarcity.
okay, so for getting out of debt, it sounds like a powerful tool. But what's the catch long term? If someone says, okay, I'm debt free, I'm just going to be cash only forever. What are the limits they hit?
That's the flip side. While cash gives you that immediate control, sticking with only cash long-term severely limits your financial power in the U.S. system. Primarily, credit history. If you're only using cash or debit, you're not building a credit score. You're essentially invisible to the credit system.
Which matters when?
When you want to do big things. Buy a house, get a reasonable car loan, maybe even finance education. Without a credit history, or with a thin file, you'll face much higher interest rates costing you way more, or you might just get rejected altogether.
So you trade that short-term control from cash for a long-term lack of leverage.
That's a perfect way to put it. You sacrifice future financial options. And there's another thing, inflation.
Ah, this silent killer?
Right. Cash sitting in an envelope
Yeah.
or under the mattress, it's losing buying power every single day thanks to inflation. evaporating slowly. Plus, you miss out on those rewards we talked about, sure, but also the consumer protections.
Like the fraud protection.
Yeah, and also chargebacks. If you buy something faulty with cash, good luck disputing it effectively. With a credit card chargeback, you have way more power to get your money back if a product or service isn't right. Cash offers very little recourse there.
Okay, so it's definitely not a simple cash good, credit bad, or vice versa. The best strategy really depends on the person, doesn't it?
Absolutely. It depends entirely on you, your discipline, where you are financially. We see really clear differences across different groups.
Like who?
Well, think about Gen Z again. You see them playing with both sides, right? They're doing the cash stuffing for control.
Uh-huh.
But they're also heavy users of BNPL. They want to build credit. You see lots using secured cards to start, but they seem really wary of that traditional high APR credit card debt. They want the function, maybe, but with guardrails.
Interesting. And then millennials, often called the optimization generation, right?
Yeah, often framed that way. They seem laser focused on maximizing rewards. You hear about credit card churning opening cards just for the sign-up bonuses.
Right, chasing those big point hauls.
And using those rewards to help fund big goals, like saving for a down payment on a house. But hold on, we call them savvy optimizers. But millennials are also carrying massive student loan debt, aren't they? How does that fit?
Good point. That's a huge burden.
That tension is key, I think. Their savviness with credit might actually be a reaction to inheriting systemic debt and maybe living through the 2008 crash aftermath. They have to master credit and leverage because they need it to overcome those big financial hurdles they started with.
So optimizing out of necessity, not just for fun travel points.
Often, yeah. It's a required survival skill for many. Then you look at the other end, low-income households. They often rely on cash because they have to, or maybe they don't trust banks. They're unbanked or underbanked.
Which keeps them out of the credit system.
Exactly. Cash helps them survive day to day, but it makes it incredibly hard to build the credit needed for upward mobility. It can be a trap.
And older generations, say 55 plus M.
They tend to use cash more frequently than younger groups, often prioritizing maybe physical safety or just the direct control they're used to over chasing rewards points. They use cash nearly twice as much as the youngest adults.
So putting it all together, it really boils down to matching the tool cash or credit to your own personality, your discipline level, right?
Precisely. If impulse spending is your Achilles heel, cash or debit needs to be your foundation, at least for those trigger categories. If you have iron discipline, credit becomes this amazing power tool for optimization and building your financial future.
Okay, so if we had to distill it down, what's the winning formula? What does the data suggest is the smartest path for most people?
It really points towards a balanced approach, but one built on unwavering discipline. That's the non-negotiable part.
Which looks like?
Use credit cards strategically. Use them to build that all-important credit score. Use them to earn rewards if you can handle it. But, and this is the giant but, you absolutely must pay the balance in full. Every single month. No exceptions.
To dodge that massive APR bullet.
Completely. That's the ultimate power move.
Yeah.
Using the bank's money for free for a month, getting rewards, and building your score, all without paying a dime in interest.
Okay, so strategic credit for score and rewards, paid off monthly. What about day-to-day spending?
For the everyday stuff, especially those categories where you tend to overspend, maybe dining out, clothes, entertainment, whatever your personal weakness is.
We all have them.
We all have them. For those, switch to cash or a debit card. Use those cash envelopes if it helps create that physical, psychological barrier.
Yeah.
Make the spending feel real again for those danger zones.
Makes sense. Now, besides the obvious mistake of carrying a high interest balance, what other critical errors do you see derailing people financially? Things people maybe overlook?
Two huge ones come up again and again in debt recovery stories. Fatal flaws, really. The first, not having an emergency fund.
The rainy day fund.
Exactly. Needs to be easily accessible, cash or savings. 3 to 6 months of essential living expenses. This is your financial shock absorber, because life will happen.
Job loss, medical bill, car breaks down.
Right. And if you don't have that cash cushion, you're forced immediately onto high-interest credit cards just to survive. And boom, the debt spiral starts or restarts. You have to build the safety net before you start chasing rewards.
Safety first, then optimization. What's the second fatal flaw?
Missing out on free money. It sounds basic, but it's shocking how often it happens.
Like what kind of free money?
The biggest one is the employer match on a 401k or similar retirement plan. People will obsess over squeezing out 2% cash back on groceries while completely ignoring the 50% or 100% match their employer offers on retirement contributions up to a certain limit.
Yeah.
That 401k match. That's an instant, guaranteed return that absolutely dwarfs any credit card reward.
Wow. Yeah, ignoring that is leaving serious money on the table.
Serious life-changing money over time. It's sacrificing substantial future wealth for the illusion of tiny short-term savings. Penny wise, pound foolish, basically.
So wrapping this all up, what's the final takeaway? Card or cash?
At the end of the day, the ultimate key isn't the piece of plastic or the paper bill. It's iron discipline, yes, but also really deep self-knowledge, understanding how these tools actually affect your behavior. The most important number you should be tracking, it's not your rewards points balance, it's your net spend compared to your budget. Are you actually saving money or just spending more overall?
Right, think about it. Are you chasing that 2% reward, but using the card makes you subconsciously spend 5% or 10% more across the board because it just feels so easy, so painless?
Exactly. If that's happening, you're sacrificing real net wealth for this feeling of convenience or optimization. Recognizing that behavioral trap, that's the game changer.
That psychological awareness, that's the real deep dive, isn't it? It's not about the tool itself, but how you use it.
Couldn't have said it better myself.
Yeah.
It's about the hand wielding the tool.
So we definitely want to hear from you. Have you gone full cash envelope? Are you a master credit card optimizer? What was the biggest surprise or challenge you faced when you committed to a strategy? Let us know down in the comments.
Yeah, share your experiences.
And hey, if this deep dive sparked an aha moment about your own spending psychology, definitely hit that subscribe button. You won't want to miss our next exploration into how things like buy now, pay later are fundamentally changing the credit game for everyone.